Huge news today, folks, coming out from the Bank of Canada. We've got another half-point cut, brings the overnight rate to 3.25. Okay, this is huge news. We know inflation is not one of the biggest proponents anymore, or decision-making factors behind the Bank of Canada's monetary policy implementation plan. It's more so this announcement and partially the other one, more weight, but the biggest weight in this basket or this decision today was unemployment, okay? And there's been a lot of talk around unemployment. I'll get into some more detail now, but the one key thing you got to remember, well, two key things you got to remember throughout this market update. Number one, unemployment numbers are not a result of job loss. The unemployment figures we're seeing in our market today are absolutely not the result of people or the workforce losing their jobs. It's actually a result of incredible inflation, and we just don't have the jobs to support the new entrants to our market. So it's easy to allow that stat to be skewed. It's easy to allow that stat to overshadow the fundamentals. But really, truthfully, just like real estate, supply and demand, when we have more demand for real estate than we have supply, prices go up. Same thing, the job market is experiencing a little bit of stress and strain right now. It's alarming. Those numbers are alarming on their own, but when we give it context and frame it, we know it's a matter of time before those unemployed positions or individuals, new immigrants, are absorbed into the market. Just a matter of time. And that leads me to my second point. Big picture, something to consider is we know how long it takes the light to get from the sun to the earth, right? Speed of light travels at whatever it does, crazy big number. But the light that we get on Earth from the sun is about 8 minutes old by the time we get here. It's like time travel. We're getting light. We're seeing light from 8 minutes ago, right? If the sun was miraculously, or knock on wood, disappeared, vanished, we would have light for 8 more minutes. Now, this leads me into my next fact or statistic that we need to, lens we need to view this information from, is that for these monetary policy effects to be cemented in the market and see effects on the numbers side, on the real estate pricing and maybe transaction volume, but more so on the pricing and the hard numbers, it's going to take time. There's a lag. So what we've seen up till now, even with consistent rate cuts, is we're seeing the effects of those high interest rates we had 8 to 12 months ago, and the lag in the market. Now, this news will propel buyer confidence, buyer narrative, maybe a bit of activity, transaction volume certainly, but pricing and normalcy and full-on predictability, there's going to be a lag until we actually see today's rate announcement have effect in the market. Safe bet, very confident bet, would be Q3, maybe fall market of 2025. Not to say there's going to be a lot of opportunity in the early half of the year in 2025, but when we really start to see the effects on the dollars, it's going to take some time for that to happen. So let's get right into it. Let me shrink my head. I'm sorry. Here we go. So Bank of Canada cut rates by 50 basis points. Our economy grew by 1% the third quarter of 2024, and fourth quarter is looking to be even weaker than projected. Okay, so the growth isn't where it needs to be. The growth isn't where the Bank of Canada wants it to be. We were anticipating faster growth with lower rates, but this leads into what I was saying about that lag. So it's all there. It's all coming. We're very confident in terms of the outlook. But by the time we actually start seeing these effects, we're just going to need a bit of time. Now, why did they cut rates? Well, job market. Okay? Job market. 45,000 or 80% of all the jobs that were effectively created for this influx of immigration were in the public sector. So why is there a lag to create jobs in the private sector? Well, it's expensive. Minimum wage has gone up. With inflation, the costs of goods and labor and materials and hard costs, soft costs have gone up. The cost to borrow and finance, whatever business the employers are in, everything costs more money. So there's a lag until the economy comes back to a little more, giving us a more sense of predictability. The jobs are going to have to come from the government, which is not sustainable, we'll say. But I'm very confident that employment will grow. Very confident that the unemployment rate will shrink as we find and maintain that normalcy, that balance. Okay, but that's the big thing right now. Inflation was, I think officially the word of the year in 2024 they said was demure. If you don't know what that is, you don't have to. I think it means like cool. I don't know. I'm out of touch now these days. But demure was the word of the year. If you ask me, I think the word of the year was inflation, because everybody and their cousin was talking about inflation. I'd go get my winter tires put on. Ty, how about that inflation? Go to get my beard trimmed. Ty, inflation, right? It was the word. It was the thing. Everybody who was anybody, even if you weren't anybody, was paying attention to inflation for the first time probably ever. Really paying attention to inflation. But now it's shifted to jobs. So unemployment, here's a little bit of unemployment. I'm going to cover that, but unemployment rate in Canada. Okay, so across the board, we know that big jump there was COVID. Coming out of COVID, we did a really good job bringing back those service sector jobs, those hospitality jobs, right? The bulk of job loss was in the, I guess you could identify them as rental markets, okay? Service, hospitality, everything that was affected and shut down by COVID. But, the bankers, the lawyers, the HR, the, classic kind of white collar and blue collar jobs were still there, and we just had nowhere to spend our money. So that is explained. But for this new jump that we're seeing, you can see toward the end here of this graph, that new jump that we're seeing, that's basically a result of population growth, okay? Now, although inflation is no longer the talk of the town, it's still something that we really do need to be paying attention to. We're hovering around that 2% mark. Okay, we're hovering around that 2% mark, and you can see the correlation and relationship there from 2018 until, we'll call it COVID, right around here, with the Bank of Canada rate and the inflation rate. We've been doing a little topsy-turvy, speed bumping, turbulent landing, still a soft landing out of this craziness we've had, which seemed elusive at the time. But we're working our way down, okay? Inflation right now, we're right on that 2% target. Now, something to note is on Wednesday, this coming Wednesday, what date would that be? Whatever, it doesn't matter. Today's the 11th, so I don't know. 18th? Let's guess. December 18th, if it's a Wednesday, the federal budget is going to be announced. There's going to be some federal conversation around basically the economy, okay, and their take on it. There might be some tidbits in there, but there's nothing crazy that I'm looking for there. It's not going to be anything of substance. This is more of substance to me. Today's news and the narrative that the Bank of Canada took, they did hint at more rate cuts, which is interesting. The question that arises now is where do we land, right? As inflation starts to normalize and we get back to that level, Bank of Canada rate comes down to match inflation. If it is around 2, 2.25, 2.5, the question now that arises is where do we stop? Where do the rate cuts stop? Okay, GDP, can't talk about the market unless we kind of talk about GDP. It's the only place I can put my head at the moment, but give that a read. Feel free to pause and give that a read. I mean, basically, we have a phenomenal quote here from an economist at Altus, just down the street from my office here. I think one of the most important factors since the last rate adjustment is the fact that GDP numbers for the third quarter were surprisingly weak, which tipped the scales in favor of more and faster cuts. So basically, just to put it in perspective, the reason we cut rates is to stimulate the economy, okay? I'll go big here. The reason we cut rates is to stimulate the economy. Coming out of COVID, there was a slowdown, the economy's slowed, and we cut rates so that there'd be more spending power, more money spent in the economy. We're not seeing the public or the consumers jump to spend that money. And another fun stat, or interesting stat to be watching, is household savings. Canadians have more savings right now than they did during the pandemic relative to income. Isn't that wild? That's a wild stat. So what we saved up during COVID when we couldn't go shop and eat and drink and watch the Leafs lose, we saved. We put that money away. And then sure, we spent it on home renovations. And when the world opened up again, we went and spent that money. So those savings that we had have been depleted and spent in a high inflationary environment. Now, as inflationary cools, we need something to stimulate that economy. We need something. And the rate cuts are meant to do that. We're just not seeing the response from the consumer as quickly as I suppose the bank would like to see. Now, in terms of market conditions, so how does all this affect real estate? Well, here you go. You've got sales to new listings ratios. Now, this is really important if you've heard me speak before about the market and the recovery. To get prices to appreciate and come back, we need transaction volume. We cannot see price appreciation without transaction volume. And I used to say in different markets, different analogies for different markets, doesn't matter if Ferrari sells one Ferrari or 1,000 Ferraris, it's still a Ferrari, it's still valuable. And that's Toronto real estate. But in a market that's appreciating, transaction volume does have a role to play because it's very difficult. Consider your own home. If your neighbor just sold for 1.2, how the heck are you going to get 1.8? It's tough to justify that to the market. So what do we need in between? We need 6 or 7 of your neighbors to sell first. 1, 3, 4, 5, 6, 7, and then maybe we can achieve 1.8. So we're going to need to see transaction volume to reinforce this growth, this gain. And when we combine seasonality right now in December, we're not seeing the speed at which we would like to see in real estate and a lot of other sectors in terms of spending, okay? But what you can see here is that the absorption rate is actually happening quicker than anticipated. So I'd say maybe 2 months ago, we were sitting at 8 months of inventory on average in the Toronto real estate market, combined of detached and condos. But that inventory has been absorbed quite quickly. The new listings haven't been coming to market as rapidly as you'd expect. I think a lot may be waiting for the new year. We will get inundated with listings in January and then of course in the spring too. A lot of people want to wait till the spring market. But buyers don't have the options that they should have right now. So they are out there pulling the trigger and purchasing homes, eating up that inventory. So we're getting back to a more balanced kind of market, really, which is a good thing for, again, predictability and just normalcy overall. Now, transaction volume is one thing, but even without an increase in transaction volume, we are seeing prices trend higher, okay? 2.6% increase in November. I mean, that's going year to year. We're seeing an appreciation in prices. We are below inflation for that year span on average. Average inflation from that year to year, we're about 3.25%. So we're still below what inflation was. This tells me there's a lot of room left for appreciation to grow. 2.6 generally good, but we know that the basically the average appreciation over the last 40 years in the GTA is 5%, hovering around 5%. So in a predictable, confident, balanced market, we're going to see about 5% appreciation. With inflation this year around 2, probably going to level out around 2, we know that the housing market, or we don't know anything, we can confidently predict that the housing market and housing appreciation will outpace and outperform inflation, which is a net positive and a good investment. Okay, you can see, in the shorter term, a little bit skewed by COVID, but that jump came with a dip. So it does average out. Last 5 years, we're at 6.1%. Last 10 years, we're at 7.1%. Okay, so prices are going the right way. Big reason for this: fundamentals are still relevant. As much as we're talking about job markets and interest rates and access to capital and CMHC lending rules, as much as we're talking about all these changes, the fundamentals are still rock solid. We have not enough land left to build on. We have not enough of a labor force to build and add supply. We have a phenomenal jobs market overall, with new employment working its way into our market in the long term. We've got phenomenal talent here from some of the world's best post-secondary institutions. We've got high costs to build, and we have immigration that is just a big one. We simply can't build fast enough for the amount of people that need homes. So that that demand will continue to outpace that supply. Okay, solvable-ish in the periphery, but not in the core. It's an impossibility in the core. Now, market balance, talked about this briefly, but new sales, we're seeing a decline in new listings, so there's your balancing act. We're not seeing listings come to market as quickly, which is great because it's giving a chance for that existing inventory to be absorbed. Okay. Rental supply outpacing demand. This is a cause and effect. This is a really simple understanding of the market now. As money gets cheaper, as purchasing power amplifies with lower rates, we are going to see more would-be renters turn buyers and kind of return to that buying market, with everyone saying buy, with the condo market super low right now, price point, right? Very saturated, lots of inventory, quite weak right now, not in full recovery mode just yet. Screams opportunity. There's a lot of those would-be tenants looking at the purchase side. So that's the explanation there. Makes total sense to me. Not to say we don't still have a phenomenal rental market. We definitely do. But with the emergence of purpose-built rentals and renters turn buyer, we're just seeing less of it. Okay, so we're not in a bad spot by any means. Our rental market is still extremely strong, just less strong than it was. Right? It's like saying, who do you want on your top power play unit, Austin Matthews or Mitch Marner? I mean, both are great options. You're going to score either way. Okay, so both great, but maybe Matthews a little better. So monthly condo cash flow as a result of lower costs. In borrowing, we're seeing some amplification in the cash flow and the returns in condos. This is great. This is a great way to predict what's going to happen in the future. So if you're looking in the pre-con market, if you're considering an investment on the pre-con side, phenomenal opportunity to watch these trends continue, okay? You think of investment property like owning a business. If I own a business, I have two ways to make more money. One, I increase my income, so we increase the rent, which is happening. The market is really calling for higher rents. Or I decrease my costs, right? I cut functions of the business. I lay off. I take a smaller space to rent. I cut my costs. I find better suppliers. Cheaper manufacturers, whatever the case is. Same thing in investment real estate. If my costs go down, that's better business. My business is worth more. So your costs are decreasing here with a lower cost of borrowing, lower interest rates. So kind of a really cool combination of factors where, wait a minute, I could buy a business today at today's values, but I know that I'm going to be able to increase my profit and decrease my costs. Okay, I'll take it. And that's essentially what we're seeing in the real estate market. Okay, so let me get in my crystal ball here. Next rate announcement is January 29th, 2025. We've got the whole rate announcement schedule posted on our social media in terms of what, when those announcements are. Based on today's announcement, based on what the Bank of Canada signaled, they did signal more cuts. The question is, where do we stop? Very likely a cut on the 29th of January. We'll see how kind of holiday spending impacts GDP a little bit and how consumers decide to spend some of those savings they've worked so hard to accumulate. Transaction volume in real estate, I'm very confident we're going to see improve and increase right away in January. So, there's always talk of spring market. These economic factors and fundamentals are going to outpace and are of more importance and more relevancy to the market right now than seasonality, right? My mother used to say, it doesn't matter if your flowers bloom solid gold. It doesn't matter. Timing is always going to be most important, and timing for buying right now, buyers should be full speed ahead. Like, your opportunity is dwindling. If you're looking to buy for the first time, invest, or move up an asset class, probably never been a better time in history. If you're looking to sell, if you're looking to downsize, if you're looking to sell and downsize, or sell and rent, or sell and move out of the country, or sell and get into a retirement home, whatever your plans are, if you're looking to sell and not take advantage of the buy opportunities, then I'm going to say you're going to want to capitalize more so on the timing of the market as well, where we have buyers out there. We're not going to see massive price appreciation until, I won't say massive, but we won't see price appreciation return to a predictable, stable level until fall of 25, based on lag, based on the time it takes for these to take effect, these monetary policy shifts to take effect on pricing. So that being said, I'd say your best bet is to list while the buyers are there and not be inundated with more competition come spring, come later in the year. Unless you've got the opportunity to wait, then 2026, if you've got big plans and you're looking to retire and move up north for good, then you know what, maybe you go through one more year of shoveling snow and cutting grass, and we deal with that in 2026. You'll probably score a little more out of your home in Toronto or the immediate suburbs, GTA. Okay. In terms of periphery markets, the Bradfords, the Bowmanvilles, the Collingwoods, the Cottage Country, anything beyond the core periphery, there's really no reason to believe that we're going to see a big jump there in the short term. They'll appreciate with the market, but they will not outperform the market. They will continue to sit until we get that confidence back in predictability and confidence back in the economy, which again could be late 26, early 27. I'll finish with pre-construction. We've got some wicked condos and projects in the city in the core where we know that the appreciation is going to be most heavily weighted in the downtown core. And a lot of these projects are completing in 2028, 2029, when the rental market will be insane. Cost of borrowing will be normalized. I mean, there's one project that we wouldn't touch, and they're telling their clients that interest rates will be back at 1.5% by then. One, impossible to predict. And two, No, they won't. We'll probably end up around the 2.5, 2.25. Okay, but anyways, that being said, lower rates combined with higher rents, completing at a time when we're going to see such limited new inventory in the market, it's a sensational time to be jumping into pre-con with some of the incentives that the builders are offering. So I'll leave you with that. I hope you enjoyed the market update. If you like it, please comment, subscribe, text me your feedback. Let me know what you liked. Let me know what you'd like to hear more of as we go forward. So thanks a lot. Have a great day. We're always here for you, whatever you need. Have a great day.